Hello, everybody. So I've just created a new Dune dashboard, one that gives you a deep, risk-oriented look into one of Uniswap v3's pools that's set up for exchanging wrapped Bitcoin and wrapped ETH. Today, I'm going to give you a thorough walkthrough to explain why I did this, what all these charts represent, and the challenges that I had to overcome to pull it all together. So let's go. So here's the outline for today. I'm going to start with why I did this, what did I learn, and then round off with the dashboard walkthrough tour. If what you are interested in is taking a look at the dashboard itself, please feel free to skip ahead to that third section. The other two sections here are all about laying out background and context for this project and won't be directly focused on the dashboard contents. I've provided timestamps to help you navigate your way through conveniently at your preference. So let's start at the top. Why did I do this? Well, my friends, it's for the shill. It's ultimately always for the shill in crypto. Let me explain with some background. I started this channel as a way to promote my teaching courses and services, as you just saw in the intro, but also as a means of sharing my professional journey into this crazy, speculative, and controversial industry. In particular, sharing the journey that I personally am on to discover and define what this tokenomics stuff is actually, and along the way, clarify what professional roles, services, and value add we can credibly associate to this field. Now, those of you who've been following the channel for a while, and I know for a fact that such people exist, you may have noted that one of the themes that's recently been emerging for me is this growing sense that in order for token economics to be taken seriously and for it to make credible claims to add value beyond just making up these just so style economic plans that we put into our token launch brochures, tokenomics has to begin to use methods that move away from being purely based on theory and hypothesis and that start making use of real factual data. And this by no means should be an impossibly hard thing to do. Blockchains work by leaving an immutable data trail. That is literally what they are. So their operations at some level are automatically self-documenting. And today, we now have this entire ecosystem of data apps and services that allow us to access and analyze blockchain data in various ways. I've made this case quite extensively in a course that I delivered a couple of months back, which teaches you how to use ChatGPT to accelerate your on-chain analytics learning journey. See, another shill, but don't worry, that course is absolutely free. The videos are already up on this channel and you can download the slides from my website. But let's get back on track now. If I am saying that real data is key to developing real tokenomics, well, professionally, that doesn't leave me with many places to go, does it? As a self-professed tokenomics expert, it puts the challenge right back to me, and I have to step up to it and really walk my talk. So I taught myself how to perform some on-chain analytics on Dune, and at the same time, I studied for a rigorous qualification in financial risk management to learn more about how to get risk-oriented insights from data. I'll later be releasing a video from that sometime soon. All of this definitely took a lot of time, but I finally feel I've gotten to the point where I have something to show for it and at a standard that is high enough for me to offer to clients as a professional service. So I've created this dashboard as a way to begin to showcase these new skills to prospective clients and potential partners. And that, my friends, is the shill. Ideally, if we're lucky, this dashboard also helps to provoke people's imagination about the sorts of things that it is possible to do with these data that could be of value to your project and your efforts. Now, I don't know if this dashboard will be successful at promoting me. I don't pretend to know it all. I'm just trying things out as I go along. I don't consider what I've made here to be a final polished product, which is why I'm calling it a proof of concept. But I put it together with three guiding objectives in mind. First, to showcase an economically meaningful problem with actionable insights, to showcase analysis, which involves more advanced and elaborate metrics, and finally, to showcase my ability to communicate. Let's go through these to explain why I think they are important and how well I think I did at achieving them. So, why showcase an economically meaningful problem? Well, a lot of dashboards out there aren't doing that much. They're just offering a simple count of this or count of that. They don't take extra steps to explain how these results connect up to specific economic concerns, or better yet, evaluate the data to come up with recommendations about specific actions and choices that an affected stakeholder might wish to take. And so why did I choose decentralized exchanges as my economically meaningful problem? Well, exchanges are a critical component of every fungible token economy. We need to understand these markets in order to plan and manage our economies the best that we can. And we need to understand these markets in order for projects to budget and manage their finances in a realistic, prudent, and risk-informed manner. And while exchanges have received the most attention from data builders in this space, and we now have this amazing variety of services and insights that we can derive from them, my sense is that these tools are still primarily geared towards supporting the interests of traders and investors. If, on the other hand, what we're interested in is improving financial planning, maintaining the health of our exchange markets for our native assets, and managing a wider token economy, I think we need a view on exchange activity that offers a different emphasis and probably a broader view. Some of you might ask, do we really need empirical data to do that? Can't we just calculate or model the token price for ourselves? Well, I don't believe we can, as you might be able to tell from that picture. And I've openly and publicly disagreed with some of my distinguished colleagues whom I respect in this field, who do include token price projections in their modeling for their clients, either using the equation of exchange, agent-based simulation, or agent-aggregated approaches that still ultimately rely on a mechanical and deterministic articulation of market processes and outcomes. I don't believe that any of these methods are good enough, unless they are checked or supplemented by empirical data. That's the caveat. And I believe that the stakes are just too high to use these methods simply because they are available, and certainly because there's not any other alternative, because that is false. We do have an alternative, real data, okay? Well, what about centralized exchanges? Aren't they bigger and more important than decentralized exchanges? Well, yes, ideally, we would include data from centralized exchanges as well, but let's take things one step at a time. I'm schooling myself on working with on-chain data, so let's stick with decentralized exchanges for now. And arguably, that's analysis that's going to be most relevant to a larger number of smaller projects who will not meet the criteria required to get listed on a centralized exchange early on in their development. And in situations where assets are trading on both centralized and decentralized venues, DEXs should still have something to tell us about the trading economics in general, as arbitrageurs are unlikely to let these venues get too far out of line. Anyway, however well I may have argued my case just now, let's look at how well did I actually do here. Does my Dune dashboard showcase an economically meaningful problem with actionable analysis? Well, actually, I think I've come up significantly short here. I don't manage to go as far as I would like to offer a more conclusive and polished analysis of the data with specific actions or recommendations. So what's my excuse? Well, as I'll soon explain, I've had to create this dashboard within the constraints offered by Dune's free tier. And for this particular subject of study focused on Uniswap v3, those constraints have proved to be very limiting. Secondly, I'm doing this in my own time, at my own expense, so that just naturally limits the resources that I have available to commit to this. But, I'm not going to keep this work hidden away in a drawer because it's not perfect. I think it's fair to show how far I've managed to get on this basis. So I present the dashboard as more of a work in progress, signposting areas where more needs to be done and what I think the expected next steps could be if further analysis was to be undertaken. Okay, my next guiding objective was to showcase analysis that uses more advanced and elaborate metrics. Again, a lot of dashboards are just doing simple counts and tallies. And actually, I understand why now, because one of the lessons that this exercise has taught me is that if you really want to do elaborate data analysis, eventually you just are much better off exploring the data, working with it in Python and R. And you also have much more flexibility over the visualizations and their layout, which becomes more important as you aspire to build more complex dashboards and information views. But all the same, I'm a bit stubborn and I wanted to see how far I could push things on Dune to try and create something that hopefully is going to stand out by employing these more elaborate and advanced metrics. And in the process, demonstrate my ability to handle long calculation sequences in SQL and show that I'm able to apply my specialist domain knowledge in risk and finance to this analysis. This wish to show off a bit has come at a cost. I expect that some people will justly criticize the dashboard for being too crowded or complex, but since it's intended to be a marketing document, ultimately I think that's the right side of the trade-off to take. Then there's something I mentioned earlier. Working with metrics that require a greater number of steps to calculate poses challenges for building that kind of dashboard using Dune's free tier. Since several calculation steps are required, they end up chewing up larger amounts of the fixed capacity that the free tier gives you to work with. But actually, part of the problem in this case was the fact that I had chosen to work with the Uniswap v3 protocol, which happens to be very verbose, by which I mean that it generates a lot of low-level data. And by low-level, I mean that this data needs a lot of pre-processing and transformation to transform it into units or elements that are economically meaningful that can then be fed into these more sophisticated measures. All of this was compounded by the fact that the mechanics of concentrated liquidity used by the Uniswap v3 protocol also implied quite complex and intricate economics for this system. So answering interesting questions about this system will naturally tend to queries that are more computationally demanding. Okay, my last guiding objective was to showcase my ability to communicate. Decision makers don't often have technical or quantitative backgrounds, and they value analysts who can communicate and who can understand the things that matter to them and their business. So I wanted to demonstrate an ability to do that, and guess what? This video is part of that effort. But not everybody will watch the video or be impressed by it, so as you can see, I've created a lot of text on the dashboard, maybe trying to make it feel like more of an in-depth analyst report. Now, I have no idea who or whether anyone will read it in the end, but that's the best I can do on this front to showcase this side of my skill set on this document. I also wanted to show that I have some awareness around technical data issues and nuance about how data should be calculated and interpreted. So I comment on those things in the notes, even though they refer to things that are imperfect or uncertain, and at the same time point to ways that they could be improved with extra analysis or resources. Okay, so that wraps up why I did this and why I've gone about it this way. Let's now turn to look at what this project has taught me and what challenges I had to overcome. I think I faced two challenges in particular that came with a bounty of teachings. The first is that Uniswap v3 is playing in hard mode and that Dune free tier is playing in hard mode. Okay, so what I mean when I say this, let's start with Uniswap v3. Am I just whining about the fact that I had to put in some effort? No, what I mean is that I had to study this protocol quite deeply in order to process its data and create this dashboard, and that it was a much bigger effort than I was initially expecting. Because it turns out that Uniswap v3 is really quite an intricate protocol, not only in terms of its critical use of mathematics, as you could see there, but in terms of how its smart contracts implement and govern different aspects of its operation, from the way that swaps occur to how liquidity is posted and removed and so on. And I had to learn all those details and understand them securely and thoroughly in order to perform this work. And I did that by spending lots of time with the protocol documentation. Now, luckily, because Uniswap has the status it does, there is ample, well-written documentation to help you with that. I've come through with an appreciation for just how elegant this stuff is and how much sophisticated economic work is being run on a mathematical arrangement that in some ways is pretty simple. At the end of the day, all the calculations to derive the historical price impact levels that we'll see later on, it just involved handling standard high school algebra. If you're interested in the details, I cover some of that complexity in day 4 of that free on-chain analytics course that I gave a couple of months ago. The next unexpected surprise is that working with Dune's free tier can be very hard. To some extent, this is a problem of my own making. I am insisting on assessing complex questions for a complex protocol, and I refuse to open my wallet to pay for extra capacity. But this was actually a really great decision in retrospect, albeit in a perverse and masochistic kind of way. I would liken it to that archetypal experience of taking martial arts training with an asshole kung fu master. Yes, they will be unreasonable. They will do things that are unfair and take every opportunity to break you and then laugh. But if you stay the course, it makes you. Had these limits not been there, I would have been working with queries which would have taken who knows how long to calculate, and I would have not been forced to learn all these better practices for query efficiency. It's tough love, but that's what it is. In practice, the way things played out were a bit more like a Sisyphean comedy. Sometimes I would add what I thought was one more small calculation to the whole thing, and then it suddenly takes 40 seconds longer to complete and maxes out. Or more infuriatingly, I would try and debug a query which for some reason, was making it through all the way to the end, but wouldn't make it through to the halfway mark. Fixing issues like these ultimately just required patience and some wholesome stubbornness, insisting on getting through that free tier window and only giving up once every last possible avenue had been exhausted, which I did end up doing in certain areas because some things just didn't work. And ultimately, I've not been able to relate parts of this data set for analysis as I would have wished to, given the constraints of Dune's free tier. So all this effort to work out how to push queries through that tiny little window was actually very time and effort consuming in and of itself, which is, again, why I ended up publishing a document which is not as comprehensive or conclusive as I had initially envisioned. I won't say that I have a totally rigorous grasp on all matters concerning query optimization. I'd say I have more of a rough sense or a feel. From what I gather, performance differences are going to differ depending on which flavor of SQL you happen to be working with. All the same, I was led to explore things like, when are joins less or more efficient than using window functions? At what point will data type conversions be most efficient? Whether conditional logic is more efficiently applied with arithmetic or using the case statement, all with the aim of squeezing through that little 2-minute runtime limit. One of the things that I did to achieve that was to take advantage of a small amount of materialization capacity that you get on free tier. And this allows you to store results from a query on Dune server, which saves overhead on calculations performed afterward. You can materialize one query on the free tier, but the downside is that when you refresh the dashboard, it won't go all the way back to refresh those materialized queries as well. And therefore, the results will not look fully up to date. But this is the best I can do. I'm not going to let that stop me from sharing a dashboard in this state. And I've signposted the issue in notes and comments, and hopefully people will give that a pass. So yeah, these are the main challenges that I faced, and that's what they taught me. Now it's time to take a look at the dashboard itself, right? So here's the real dashboard. The first thing that I want to point out is that this is definitely best viewed on a desktop, and that's how the layout was designed to make some sense. But unfortunately, it won't always look exactly like you can see now. All these different blocks tend to snap to different parts of the screen, depending on your resolution, the zoom you have loaded on your browser. That's nothing that I can control. So if it looks a bit wonky, just adjust the zoom a bit to see everything snapping nicely into place, hopefully. We start off with this intro section. I basically summarize some of the key points that I've been talking about earlier in the video, then provide some info, links to other parts of the dashboard. That's a cute feature that the Dune team have created for these tools. And also links to external resources, Etherscan, and link to the Uniswap app, and one to Deck Screener. I probably shot myself in the foot a little bit there. That was an idea that I came up with when I thought this was going to be a fully dynamic, refreshable dashboard. But that's not the case, unfortunately, because of these materialized queries. Nevertheless, we can take a quick look at what's loading. So this is Deck Screener, and if we go down, we can see the query reports $200 million in TVL. Liquidity is 197.4. Can we call that close enough? And let's see if we load the Uniswap app, it's a bit dark here. Can I change? Hopefully you can see the distribution. It looks like we've got a tail. The active price is sort of here. We've got like this landscape going on the wheat side. If I bring up, we have a very similar profile here, the tail, a bit of skyscraping here. So we are pulling up data that's similar, even if it's not quite to the minute or with some margin of error. If we scroll down, the first chart section is I've headed as the WBTC swap price risk summary analysis. I'm putting myself in the shoes of someone who is looking at comparing different exchange venues for trading a wrapped Bitcoin and trying to think about whether this pool is an attractive option for me. So this chart is of the swap price of wrapped Bitcoin for this pool, and I dollarize it using the broad market price of WETH. And, I've charted the buy sell volume of WBTC there. Look, I'm going to own up to this. This is a bit of a vanity chart, something that looks cool. You've got the moving average, two moving averages, which some people use to make some technical decisions. The chart that begins to offer some meaningful analysis is this one right below, which plots the price difference in percentage terms of this pool relative to the broad market price for wrapped Bitcoin. When I was exploring this data, I found that there was a lot of variation. So what I decided to do was plot the average daily percentage difference, which is this golden curve here, and then also chart the largest deviations above or below the broad market price. And that's plotted with these blue and orange series here, which you could see show some incredibly sharp spikes that deviate from the broad price by over 50% on some occasions here. But by and large, these are isolated events, and everything else sort of stays, maybe 3 or 4x what we're seeing from the average level, the most extreme movements. And if we look at the average daily movement, it does stay quite close to, everything's relative, right? But it doesn't stray terribly far from the zero level. What's interesting as well, just sort of eyeballing this, we're not measuring it precisely, but there's a bit of persistence. If we look through the series, when there's a discount, that discount tends to persist, even if there's volatility around that. And when there's a premium, the same applies. We currently seem to be in a sort of little bit of a premium phase. The other thing that I do here is I say, okay, well, let's investigate how our daily returns would be distributed if we are trading WBTC through this pool. So I calculate the daily returns, and then I chart them here on this frequency chart or histogram, which gives us a plot of the empirical distribution of those daily returns. And we see it looks like what we would colloquially call a bell curve. And I've charted this. The green line there is the cumulative frequency. So if you want to see how much of the observations does that represent in total, I've charted that there. But returning to this question, is it like a true bell curve, a normal distribution? So to get at that question, incidentally, if it is, that helps us a lot because we can create an efficient statistical model to assess the risks of our investments, trying to realize returns through this pool and so on and so forth. So it's an interesting question to ask, and I address it in several steps. Here, visually, I overlay the true normal distribution that would be associated if we provide it with using the mean and the standard deviation of the observed daily returns. So we can see if once we do that, that our observations are actually a bit more peaked in the middle, and there's a bit more fatness around the tail. To kind of like provide a bit more detail into that, I've created a QQ plot, which sort of matches the quantiles or percentiles of these distributions together. And we see, if it were normal, it would be on this orange straight line here, but we see those deviations. First, there's a little bit less mass than there would be in the normal distribution. Then once we get over that peak, there is more mass than we would see in the normal distribution, and just a tiny little bit of fatness around the tails. To quantify that more precisely, I've calculated the skewness and the excess kurtosis. The excess kurtosis is the extra fatness in tails relative to the normal distribution. And skewness tells us, does it have a little bit of a bias one way or the other? And the negative value tells us that it's the distribution actually has a few more observations in the going towards the negative daily returns. And to sort of like try and size the risk of our returns, I've calculated the value at risk at the P99 level. So what this tells us is that looking at the past observational data, 99% of the time our returns are higher than negative 9.3%. You have the wording and precise wording of these things is a little tricky. You have to practice it. And if we were to, to get some sense of sort of like the extra risk that's in that tail, we can average the results in that tail to calculate this measure called the expected shortfall. And we get minus 11.7%, which isn't dramatically bigger than the VAR, but the big caveat here is that we have very few observations in the tail. So it's unclear if this series is, has enough observations to really inform us about that tail risk. Very interesting issues there. Okay, the next big chart section is all about liquidity. And this section in particular focuses on the liquidity profile of this exchange pool today. Now, liquidity has special significance in the context of AMM exchange pools because it is very precisely defined and it is mathematically linked to the way that swaps are actually priced. Blockchain technology, furthermore, gives us a lot of detailed visibility into the actions that liquidity providers are taking on this pool. So all of that permits us to create some really detailed and consequential analysis around liquidity. Here on the left, we're focused on TVL issues and a little bit on the question of how liquidity is distributed. So we see there's a very sort of uneven placement of wrapped Bitcoin on the right and wrapped ETH on the left. And it's, we can only guess what the intentions are, but if there's more wrap ETH on the left there, that suggests that LPs believe that there's a chance there's more risk on the downside for wrap Bitcoin, right? Because then if trading moves into that range, then they start collecting more fees. So that's maybe what that represents. There's a bit of lopsidedness in the TVL overall, as we'll see. We've got the WETH in the pool, the WBTC in the pool. I'm also tracking how the TVL changes. If there are sustained changes, that might give us some sort of indication about some sort of sentiment about the health of this pool in particular. Maybe that's more relevant for smaller projects. Moving on to the next one, the way, as I said, liquidity is linked to the way that prices are swapped. So the bigger your order size, the more the pool has to pay out to you. And the mechanics of the way the prices are determined means that for bigger order sizes, the price that you get is going to deteriorate. And how much it deteriorates by is set mathematically. So what I've done is I've created this chart which shows you in US dollar terms how big does your trade order need to be in order to create a price impact of X% over the current instantaneous price in the pool. So for example, quite dramatic here. This is a huge pool. We're talking about wrapped ETH and wrapped Bitcoin, some of the most economically relevant digital assets in all of blockchain, right? So this pool is absolutely massive. And what that means is that it attracts a lot of trading interest, which means that it attracts a lot of liquidity provision in order to sort of earn fees from that interest and activity. And what that means is that trade sizes need to be very, very large in order to move the price by much. So specifically here, this tells us that you would need to sell about $100 million worth of Bitcoin to move the price by 30% or something. So the numbers are quite large. And that's part of the reason why I decided to focus on the one basis point level to start looking at impact in a bit more of a specific way. So if you trade about $9,000, you're going to move the price by 1 basis point over like I said, the current instantaneous price. The standard deviation of that over the past 7 days, though, has been like around 2,000. So, we can think of that as, being maybe 11 to 7,000. But actually, it's a bit tricky to make that kind of inference. If we look over the 30-day period, there have been some very considerable differences in the maximum and minimum level of that 1 BPS level. There is a lot of intraday volatility here. Moving on, we have charts that begin to explore kind of the user economy, the user profile of liquidity on this exchange. The pie chart first gives you a breakdown of how liquidity is split out over different addresses. At the end of the day, we can't truly identify individuals or a coherent set of interests. The blockchain data just grounds out at an address, but that still provides some meaningful information. And what we see here, if we look at 1, 2, 3, 4, these guys represent almost 50%. These addresses represent almost, because it could be the same person with all 4 addresses, represent 50% of all liquidity in this pool, which seems quite large. But actually going around the circle, we see that there's not a pretty even distribution of liquidity. It's sort of shared out. And this slice here is, I've actually aggregated all of the holders who have all of the addresses who have less than 0.5% of the total liquidity in the pool. And they make up for around 20%. So there's some concentration, but also a very healthy amount of disbursement and of that liquidity. We're currently counting maybe 1.7 thousand addresses with active liquidity positions, 200 new addresses in past 30 days, 140 left in the past 30. Another question I wanted to ask was, like, how long do these guys keep, or how long is a single address active? They may open and close various positions, but how long is a particular address active in this pool? And over the past 30 days, it's about 500 days is the average. And the exits, sometimes people either remove all their liquidity or never come back, or decide they want to adopt some kind of obfuscation tactic and burn their addresses and open new ones every now and then. So what's the length of time there? The average length of time is 250 at the moment over the past 30 days. Moving down, we then start to explore, how does liquidity, has behaved? Well, how have all of these sort of attributes changed over time? First, we're looking at TVL on a US dollar basis. And looking back, it's quite interesting. We sort of see that for the pool as a whole, certain periods show that there was a much more even balance between WETH and BTC. But over the past 18 months, there's definitely been a bias towards WETH. It's not clear how to interpret that. but again, it may be indicative of some sort of downside expectations. One of the things we can do is to explore those changes a little more closely is to, instead of measuring total value locked in dollar terms, we can measure total value locked using the special units that the V3 protocol has for its own internal calculations. And what that gives us is it gives us a measure of pool liquidity that is invariant, that doesn't change with the US dollar price. So that's what I've done here and normalized it to a percentage terms. And we do still see that slide and that growing share of wheat for the pool overall. I've overlaid the actual price of wrapped Bitcoin there, and it doesn't look like that's what's driving it. I don't see any clear relationship. So maybe that does suggest some kind of a bias or bet on where the risks are, or where LPs think the risks are. Moving down, we have the chart that I think I was most excited to be able to generate or put together. This is a historical series of the price impacts for different price impacts for the pool and how they change. So I've actually charted three of them: the 100 basis point level, the 10 basis point level, the 1 basis point level, and I've done that for trades in both ways. I've mirrored the axes of the chart, and they look pretty symmetric within this range. Actually, technically speaking, the 1 and 10 are almost always going to be exactly symmetric. I provide text explaining that in the for why that is in the diagram. It basically, just read the box. I'm not going to go into it here. The 100 level is going to be asymmetric, but not strongly asymmetrical. Other than these volatile periods here, which I'll talk about in a second. Why is this interesting? Why do I find this interesting? This really relates to the kind of problems that I was engaging with clients and startups, and who are trying to manage their treasuries and their native assets, and tap the financing they make available to support the project in a sustainable way. But what always happens is that they overspend, they crash the price. So having a chart like this allows us to begin to ask some really interesting and precise questions about treasury management and treasury policy. So suppose we want to operate by a policy where we don't want to liquidate tokens if they create a price impact that's larger than X, larger than 10 basis points, say. Data like this then allows us to back out how much spending we might be reliably and sustainably be able to sustain and execute in these markets without breaching that target or that policy requirement. And instead of sort of just looking, putting your hands together or praying, or we're still hoping that your market makers understand what you want to do and will be totally trusted to do what you've asked. This is really getting to some of the issues that I personally really care about. It doesn't go all the way to give you a clear view, but I think it's a big step in that direction. So I really like this chart. It's really cool there. Actually, let's talk about that volatility. I'm pretty sure those volatilities, those spikes are artifacts, and they don't represent sort of like the average tendency in this data series. The way this has been calculated is by using end of day balances. So if there's intraday volatility at some point, that cutoff is going to land on a moment where some LP was doing something funky, swapping in, sniping large amounts of liquidity in and out of the pool. And that's what I think those spikes are, because they're pretty erratic. If we look further down, we'll see that those spikes do coincide with big changes in pool concentration and TVL. So I'm pretty sure it's down to one or two large players. Now, the way to sort of get rid of that and or understand the contribution of those impacts in a better way requires us to process this data at a finer level of detail, ideally at transaction level rather than at end of day level. But as I was saying, Dune's free tier is restricted, so I wasn't able to squeeze that through, and this is the best we can do. So I've put a pin in that as a point for improvement. It would be interesting to then look at the distribution of that price impact level, and that's what I've charted here. But again, I think these crazy spikes have created a distribution with a ridiculously long tail. I think these are artifacts. They're not representative of certainly the average volatility that we capture at end of day. So I don't read too much into this chart. I would need to redo this, like I was saying, on a transaction level, then chart that distribution and then see if anything interesting starts coming out. Underneath, we have a section that returns the focus on the LP, the LPs themselves, or at least the addresses, and we chart the TVL balance of the pool in virtual units. So again, to strip out the kind of effects of dollar price changes, and the HHI, which is a way of sort of like taking that pie chart and reducing sort of like the concentration to a single number. And as I said, we see these spikes here, which suggest that, big players are sniping in liquidity at these particular moments, but it's probably an end of day artifact. And yeah, the figures for the HHI are pretty low in terms of values. What are we getting there? We're getting like something like 4 or 5%. Now, in conventional analysis, when you're working with the HHI to analyze competitiveness in service or product markets, you're told that a low value, a competitive market is anything lower than 15. But we've got to be careful. We're now working in a completely different economic context, and it's not clear what high or low is for the HHI. We just need to accumulate more data, and see how it relates to risky events in order to try and get a sense of what is high or low within the context of a decentralized exchange pool. But I'm certain it all fits a picture right. This is one of the most important, largest, most important pools. It's going to have some of the most diversified liquidity participation out of all of the pools we have in the ecosystem. So, I'm prepared to say that this is actually genuinely low concentration, relatively speaking. Down here, I plot in the new address entrants and the exits, and the balance of active addresses. You see that actually over the past 18 months, I would say the number of addresses has sort of been stable. It's sort of like, hovered in some kind of range. This again is, maybe the basis of some kind of indicator about shifts in sentiment. If we, predict this out and we suddenly see a sharp move in some sort of direction, that could be an early warning indicator that something's afoot. To drill down into this area further, I've decided to explore, how many days have liquidity providers been active at this pool for, holding one position or another open. And we see this upward drift in the number of days, but the total number of users has flatlined. So that suggests that there's a cohort of sticky or passive users who are just sort of hanging around and interacting with this pool using the same address. But who are they? Are they bigger players? Are they smaller players? In order to answer that, what I've done is I've weighted that metric by the share of liquidity they have in the pool. And once I do that, we get this purple line here, and that comes down, right? That tells us that the bigger players are more active. They're holding on for less time. And the number of days exited is charted in this blue line, which is really noisy. So I've overlaid the 30-day average to kind of like denoise it a bit. And we do see a little bit of integration between the purple, some eyeballing it, you would need to quantify it. Does seem to be some tracking between the red line and the purple line there. Again, filling in this picture that, which is very intuitive economically, that the large LPs are going to be more economically active. So let's look at, how the distribution of how long addresses tend to stay active in this pool for. And there's, I don't know, I guess, was I surprised by this? I don't know. I'm just starting to learn about these sorts of data, right? So I don't know how this sits in context, but what we got, 4 or 5 days, 25% of addresses are ending their interaction with their pool at 5 days or less, 6 days or less, 5.5 it says here. So that's a lot of churn. And I guess the next step would be interesting to see, are those larger LP holders or the smaller LP holders? This may be a way into exploring the question of how much incentive is there, how much activity is there in people actively trying to hide their exchange activity by churning through address activity. Now, no conclusions on that here, but this is the data sort of begins to open doors to exploring that. This scatter chart here tries to explore the relationship between the size of an LP's position and how actively they manage it. And we do find a positive log linear relationship. The larger your liquidity position, the more volatile it is, the more it changes in terms of the absolute number of virtual liquidity units that are associated with your address. And there's quite a spread there. Another thing I sort of like tried to look at here is, are there any sort of changes in behavior over time? So what I've done is I've labeled all of these exiting addresses by the half year in which they began interacting with this pool. And it looks like a mess, but you can get some sort of like a slightly clearer view by just hovering your cursor over and sort of seeing what the dots look like. Visually, there's nothing that's popping out here really. sort of like clear patterns. What is, blindingly obvious is this very clear separation between these guys here and these guys here. I don't know what this is. The first, I would have to dig in deeper. My first guess is that maybe it captures some LP addresses that are using some kind of automation that allows them to be much more active than a human address would be. And yeah, I don't know, but this is what this journey looks like. You start uncovering things with the data, and it's highly iterative. And the process gives you ideas of what to do next as much as it gives you insights. So yes, there you have it. That's the dashboard. And as you can see, there's just so much data and there's so many directions that you could take. So I guess this dashboard is more indicative of an exploration that is still in progress. I need to work with partners to distill it down, to identify the metrics that really, really matter to them and that are going to be effective at driving clear decision-making. If you want to work with me to do that, just reach out. As you can see, I'm super fascinated by this stuff and I genuinely find it interesting. I will be continuing to work on this project in between. So like little bits of client work that maybe aren't related because I need to keep food on the table. But given all the limitations that I see on Dune, I think it's clear that I'm going to have to shift this out into Python. And that's going to be really exciting, a lot more freedom, and therefore maybe a lot more discipline that I have to apply in order to make sure that, I keep that organized and focused on actionable deliverables. So let's see what comes out of that. I'll definitely be making another video to show what comes out of that when it's ready, which I don't know when it will be. Anyhow, thank you for sticking all the way to the end. I hope you enjoyed it. And yeah, like I said, if any of this interests you, just please feel free to reach out. Next video is going to be one on that risk certification that I took out, the FRM, which may be of interest. I don't know. It's going to be out, soonish. So yeah, hope to see you there. Bye-bye.